3 weeks ago, I noticed something in a data set that I almost scrolled past. A number on the Shanghai Futures Exchange Vault report had changed, not by a little, by a lot. So I opened a spreadsheet and started tracking it day by day, then week by week. And what I found pulled me into a rabbit hole that I have not been able to climb out of since. If you own physical silver, if you hold mining stocks, if you have been watching the price crash and wondering whether you made a terrible mistake or whether something else entirely is going on, this video is going to answer that question. I am going to walk you through exactly what I found in the order I found it, so you can see what I saw, and somewhere around the 12-minute mark of this video, you're going to hit a piece of information that will make you pause and rewind. I know, because that is exactly what happened to me. It started with one chart. Welcome to the SHF Money. If this analysis opens your eyes to something the mainstream missed, hit like and subscribe. It helps the algorithm put this in front of the people who need to see it. The Shanghai Futures Exchange, the SHFE, publishes its vault inventory data. This is not opinion. This is not analysis. It is not some guy on the internet guessing. This is the exchange itself reporting how many tons of physical silver are sitting in its warehouses. Real bars, real vaults, audited numbers that get updated daily. I went to CEIC, one of the most respected economic data platforms in the world, and pulled the time series. In mid-December 2025, the SHF reported approximately 900 tons of physical silver in its vaults. The number I saw on February 4th was 423 tons. I stared at it. Then I refreshed the page. Same number. So I pulled the previous day, 449. The day before that, 462. The day before that, higher still. I went back day after day after day. Every single entry was smaller than the one before it. Not most days. Not on average. Every single day the number went down. I pulled 6 weeks of data and could not find a single day where inventory increased. That is not a fluctuation. That is not seasonal. That is a one-way door. Silver is walking out of those vaults and not coming back. Let me make sure you actually feel the scale of what I am describing, because numbers without context are just noise. 900 tons to 423 tons in 7 weeks. That is a 54% drawdown. More than half of China's main exchange, silver vanished in less than 2 months. And the weekly drain rate is 42.6 tons. The daily drain is 10.78 tons. And if you overlay the chart, the angle of decline is getting steeper, not flatter. The drain is accelerating. Now, put that in global context. Combine the SHF vaults with the Shanghai Gold Exchange vaults, and you get roughly 900 tons total across all Chinese exchange accessible silver. That is 29 million ounces. Sounds like a lot until you realize that the world consumes over 1.2 billion ounces of silver per year. All of China's exchange silver covers 2.4% of 1 year of global demand. 2.4%. That is not a cushion. That is fumes. Now, I'm going to do something that none of the articles about this data did. I'm going to run the math forward. If the drain rate holds at 42 tons per week, and current inventory is roughly 412 tons, according to the latest improved terminal data, then you divide 4.x, 42, and you get 9.8 weeks, call it 10. In 10 weeks, at the current rate, SHF silver vaults hit zero, not low, not concerning zero empty shelves, nothing left to deliver against futures contracts. Now, if you're sitting on physical silver or silver miners right now and you just watched a 53% price crash, I need you to understand what this number means for you. The exchange that backs stops a huge portion of Asian silver price discovery is running out of metal. I am not predicting this will happen. Drain rates can change, metal can flow back in, but no one in the mainstream financial press is even running this calculation. And that alone tells you something about the quality of the coverage you're getting elsewhere. Now, here is where my research took its first unexpected turn. I wanted to know if this was just a China story. Maybe Chinese industry is pulling metal for solar panels and electronics, and this has nothing to do with anything bigger. That would make sense. China is the world's largest consumer of industrial silver. Case closed, right? So I pulled the COMEX data and my stomach dropped. COMEX is the main silver futures exchange in the United States, run by the CME Group. It is where paper silver gets traded and where theoretically you can demand physical delivery. According to data reported by the Kubi letter and confirmed by multiple sources, COMEX silver inventory dropped to 415 million ounces in late January 2026. That is the lowest level since March 2025, a 34 million ounce drawdown from its recent peak. But here is what really caught my attention. According to detailed analysis from Shift Gold, the registered silver on COMEX and registered means the metal that is actually earmarked and available for delivery against futures contracts has been seeing major outflows since September 2025. Eligible metal, which is metal stored in COMEX approved warehouses but not yet designated for delivery, is being converted to registered just to satisfy the demand from people standing for delivery. And here's the critical part. The exchange is not bringing in new metal. No fresh silver is arriving in the vaults. They are simply reclassifying what they have. It is like a restaurant running out of food and renaming the appetizers as entree. The menu looks full, but the kitchen is empty, so it is not just China. COMEX is draining too. 2 of the 3 largest visible silver inventories in the world are losing metal at the same time. At that point in my research, I did not want to check the third because I already suspected what I would find. I went to the London Bullion Market Association data. The LBMA operates the largest physical precious metals market on Earth. And according to analysis published by AU Bullion Canada and multiple precious metals researchers, the LBMA's estimated free float, the silver that is actually available to settle London's massive unallocated accounts, has collapsed to what one source described as the lowest level in modern history. According to a detailed report on Trading Key, for the first time in modern history, all 3 major transparent silver inventories, Shanghai, COMEX, and London, are draining at the same time at record speed. The report estimates that nearly 1 billion ounces of refined silver have vanished from visible stocks since 2021. Now stop. I need you to hold those 3 facts together. Shanghai draining, COMEX draining, London draining. Same direction, same time, same metal. Solar panel manufacturers need roughly 20 grams of silver per unit for conductivity. Electric vehicles use nearly twice as much silver as traditional combustion engine vehicles. 5G infrastructure, semiconductor production, and defense applications all require silver in quantities that cannot be easily substituted without sacrificing performance. So, what happens when the world's largest supplier cuts off 60 to 70% of export flow? Prices rise until demand destruction kicks in. But demand destruction in industrial applications does not happen at $100 per ounce or even $150 per ounce. It happens when the cost of silver becomes so prohibitive that manufacturers either redesign entire production systems to use less silver or shut down lines completely because substitution is not technically feasible. That threshold is much higher than most people think. And even when substitution becomes economically attractive, the timeline to implement those changes is measured in years, not months. You cannot redesign a solar cell architecture or retool an electric vehicle production line overnight. Which brings us to force number 2, the paper silver credit crisis. For decades, global silver price discovery was controlled by futures trading on COMEX and the London Bullion Market Association. At one point, the notional ratio of paper silver to physical silver reached as high as 356 to 1. That means the amount of silver promised on paper far exceeded the amount of metal that could ever be physically delivered. This system worked as long as one critical assumption held. Nobody would ask for delivery all at once. In early 2026, that assumption failed. Institutional investors started demanding physical delivery in unprecedented volumes. Hedge funds that traditionally rolled contracts forward started taking metal off the exchange, and sovereign wealth funds began accumulating silver as both a monetary asset and a strategic industrial reserve. The result was a liquidity crisis in the paper market. Market makers who provide bid-ask spreads started stepping back. Volatility spiked to levels that made orderly trading difficult, and the spread between futures and physical widened to the point where arbitrage, the mechanism that normally keeps prices aligned, stopped functioning effectively. Here is why this matters for price. When the paper market loses credibility, the entire pricing mechanism shifts to physical supply and demand fundamentals. And those fundamentals show a market that is structurally short. If COMEX faces a delivery failure where they cannot honor contracts with physical metal, it would not just be a silver story. It would expose the fractional reserve nature of commodity futures trading and could trigger cascading shocks across other metals markets. Gold, platinum, palladium all trade on similar structures, where paper claims exceed physical backing by wide margins. A failure in silver would force investors to question whether any of these contracts are actually backed by deliverable metal. And that loss of confidence could drive a flight to physical assets that pushes prices far beyond what traditional supply-demand models predict. Now, let me be clear about what I'm not saying. I'm not saying COMEX will definitely default. I'm saying the probability of delivery stress in March is higher than it has been in decades. And I am saying that even if they avoid outright default, the mechanisms they use to avoid it, cash settlements rule changes, emergency margin hikes, will all signal to the market that physical supply is constrained in ways that paper contracts cannot solve. Force number 3, industrial demand that cannot flex downward. Unlike gold, which is primarily an investment and jewelry asset, silver derives 50 to 60% of its demand from industrial applications. Solar panels consume over 25% of annual global silver supply, and that percentage is rising as photovoltaic installation accelerates globally. Electric vehicles require substantial silver for sensors, wiring, and power electronics. Semiconductors need silver for its unmatched electrical conductivity. And new demand is emerging from AI data centers that require vast amounts of power infrastructure and cooling systems, all of which use silver. Here's the key difference between industrial demand and investment demand. Investment demand is elastic. When prices rise, investors can choose to sell. When sentiment shifts, capital flows out. Industrial demand is inelastic. A solar panel manufacturer cannot produce panels without silver. An electric vehicle assembly line cannot run without the components that require silver. A semiconductor fab cannot make chips without silver paste. So when prices rise, industrial buyers do not reduce consumption. They pay whatever the market demands because the cost of shutting down production is far higher than the cost of expensive silver. This creates a price floor that keeps moving higher. In 2020, silver averaged around $25 per ounce, and industrial demand stayed strong. In 2025, silver surged to $70, and industrial demand did not drop. In January 2026, silver hit $120, and manufacturers kept buying. The sell-off to $75 did not change the underlying consumption pattern. It just gave industrial buyers a better entry point to lock in supply. And here's where the math gets uncomfortable. If industrial demand alone consumes 60% of annual mine supply, and investment demand consumes another 30%, that leaves only 10% available as buffer inventory. But we are not building buffer inventory. We are draining it, which means every ounce of industrial consumption pulls from a shrinking pool of above-ground metal. At some price level, substitution becomes attractive. Researchers are working on silver-free solar cells. Automakers are exploring ways to reduce silver content in vehicles. But those technologies are years away from commercial scale. And even if they arrive, they reduce the rate of demand growth. They do not eliminate demand. So the question is not whether industrial demand will fall. The question is, what price finally makes substitution economically viable across enough applications to reduce total consumption by the 200 million ounce annual deficit we are currently running? Most analysts believe that number is somewhere north of $150 per ounce. And even then, the transition takes years. Force number 4. Mine supply that cannot respond to price signals. 70% of silver production comes as a byproduct of mining other metals like copper, lead, and zinc. That means silver supply is not driven by silver prices. It is driven by the economics of the primary metal being mined. If copper prices are strong, mines produce copper, and silver comes along as a byproduct. If copper prices are weak, mines cut production, and silver supplies falls regardless of what silver is trading at. This creates a structural problem. Even if silver hits $200 per ounce, it does not automatically incentivize new silver mine development, because most silver is not mined for silver. And for the 30% of supply that comes from primary silver mines, the timeline to bring new production online is 7 to 15 years. You need to find a deposit. You need to secure permits. You need to raise capital. You need to build infrastructure. And you need to ramp up production to commercial scale. None of that happens quickly, which means the supply response to current prices will not show up until the late 2020s or early 2030s. In the meantime, we're relying on existing mine output, which is flat to declining due to ore grade depletion and underinvestment in exploration over the past decade. Recycling helps, but recycled silver only provides about 15 to 20% of annual supply. And recycling rates do not spike dramatically when prices rise, because most silver in industrial applications is used in such small quantities that recovery is not economically viable. You cannot economically recover the 20 grams of silver in a solar panel. You cannot economically recover the silver in a printed circuit board. So recycling provides a steady baseline, but it does not solve the deficit. This is the impossible triangle. You just watched silver collapse from $120 to $75 in less than 10 days. You saw 32% of your position evaporate, while analysts scrambled to explain what happened. But here is what they are not telling you about this crash. The actual physical supply situation got worse during the sell-off, not better. While paper silver tanked, registered COMEX inventory kept bleeding out. Shanghai premiums widened instead of narrowing. And the industrial buyers who need actual metal kept paying whatever the market demanded, because their production lines cannot stop. So let me ask you something that should make you uncomfortable. What happens when the gap between paper price and physical reality becomes so wide that the entire pricing mechanism breaks? What happens when contracts promise 425 million ounces, but vaults only hold 103 million ounces of deliverable metal? And what happens when the world's largest refiner, controlling 60 to 70% of global supply, decides it would rather keep the metal at home than export it to foreign manufacturers? If you have been watching silver long enough, you know that violent price swings mean nothing if the underlying structure is shifting. The Hunt brothers proved that leverage kills squeezes, but they did not prove that physical supply shortages resolve themselves. 2011 proved that sentiment can reverse fast, but it did not prove that industrial demand becomes elastic. And the Reddit squeeze proved that retail enthusiasm fades, but it did not prove that exchange inventories magically refill when contracts come due. This time, the mathematics are different. This time, we are not talking about speculators chasing momentum. We are talking about Samsung locking up mine output 2 years in advance because they cannot risk supply disruption. We are talking about COMEX registered inventory down 70% since 2020, while open interest sits 4 times higher than available metal. We are talking about a 5-year cumulative deficit of 820 million ounces that cannot be filled by recycling or substitution at any price that makes economic sense for most applications. So, before you dismiss this as another hype cycle, let me be very clear about what I am showing you today. This is not a prediction based on technical patterns or sentiment indicators. This is a walkthrough of the supply-demand imbalance that multiple investment banks and commodity analysts now agree has no resolution at current price levels. Bank of America says silver could hit anywhere from $135 to $309. Citigroup called for $150 within 3 months before the recent sell-off. And independent analysts tracking physical flows are pointing to structural forces that suggest even those numbers might be conservative if certain delivery pressures materialize in March. The question is not whether silver goes higher. The question is what price level finally triggers enough demand destruction to rebalance a market that has been in deficit for 5 consecutive years. And more importantly, what do you do with that information right now while price is sitting 70% below the January peak? If you're serious about understanding what is actually happening in silver and not just chasing headlines, then make sure you subscribe to this channel and hit the bell icon so you do not miss the next update. And if this breakdown helps you see the market more clearly, hit the like button because it tells me you want more of this kind of analysis instead of surface level hype. Let me start with the number that changes everything: 200 million ounces. That is the projected supply deficit for 2026, according to multiple industry sources tracking physical flows. Not the paper deficit that futures traders argue about. Not the theoretical deficit that assumes recycling picks up or mine supply magically increases. The actual physical deficit, after accounting for China export controls, after accounting for COMEX inventory drainage, and after accounting for industrial demand that cannot be reduced without shutting down production lines. To put that in perspective, the entire COMEX registered inventory, the metal that can actually be delivered against contracts, sits at roughly 103 million ounces as of early February. That means the annual deficit is nearly double the total deliverable supply in the world's largest silver exchange. Now here's where it gets interesting. Silver has been in deficit every single year since 2021. The cumulative shortfall from 2021 through 2025 totals approximately 820 million ounces. That metal came from somewhere. It came from above-ground inventories that had been building for decades. It came from COMEX vaults that are now down 70% from their 2020 peak. It came from LBMA vaults in London that have lost roughly 40% of their holdings. And it came from Shanghai vaults that are now sitting at 10-year lows despite China being the world's largest consumer of refined silver. Those inventories are not infinite, and the rate of depletion is accelerating, not slowing. Between early January and mid-January 2026, COMEX saw 33.45 million ounces physically withdrawn for delivery in just 7 days. That represented 26% of registered inventory disappearing in a single week. But here is what most people missed during that drawdown. A significant portion of what gets reported as registered silver is either not eligible for immediate delivery or already encumbered in ways that make it unavailable when contracts come due. The pool of truly deliverable, fully unencumbered silver is smaller than the headline numbers suggest. And as the March contract approaches its first notice day on February 27th, we are about to find out exactly how much metal is really available when 85,000 to 91,000 contracts are theoretically standing for delivery. That represents 425 million to 455 million ounces of theoretical delivery obligation. Even if only 20% of open interest demands physical delivery, a conservative estimate based on historical precedent, COMEX does not have enough registered metal to fulfill those obligations without either draining inventories to near zero or forcing cash settlements that would expose the structural fragility of the paper market. Now, let me show you what happens when supply gets this tight. Physical premiums start diverging from futures prices. In Shanghai, silver is trading at premiums exceeding $10 to $12 per ounce above the COMEX futures price. That is not speculation. That is industrial buyers bidding up physical metal because they need it for production, and they cannot afford to wait for futures convergence that might never happen. In London, lease rates the cost of borrowing physical silver spiked to levels not seen since the Hunt brothers squeeze in 1980. When lease rates spike, it means holders of physical metal are demanding much higher compensation to lend out their inventory because they understand that getting the metal back might be difficult or impossible if the market tightens further. And here's the part that should concern anyone holding paper silver. The spread between physical and paper is not closing. It is widening. That tells you the market is repricing risk. It tells you that smart money is no longer willing to treat a futures contract as equivalent to a bar sitting in a vault. And it tells you that when the next wave of delivery pressure hits, the paper market might not have the credibility to hold price down, even if sentiment turns negative. Because at the end of the day, you cannot deliver a spreadsheet to a solar panel manufacturer. You cannot deliver a futures contract to an electric vehicle assembly line. You need actual refined silver bars that meet purity standards. And that metal is becoming harder to source at any price. So let me walk you through the 4 structural forces that are driving this entire repricing and why none of them resolve at $75 per ounce or even $150 per ounce. Force number 1, China export controls. On January 1st, 2026, China implemented new restrictions requiring exporters to obtain special government licenses before shipping refined silver overseas. Only large, state-approved companies with annual production capacity of at least 80 tons and credit facilities exceeding $30 million qualify. That effectively shuts out hundreds of smaller and mid-sized exporters who have historically supplied global refineries and industrial users. Why does this matter? Because China controls 60 to 70% of global refined silver supply. Even a partial restriction creates an immediate global supply shock. This is not the first time China has used this playbook. They did the same thing with rare earth elements, where export controls reshaped global supply chains and gave China pricing power over materials critical to technology manufacturing. Now they are applying the same strategy to silver. The stated reason is to prioritize domestic industrial use for solar panels, electric vehicles, semiconductors, and clean energy infrastructure. The unstated reason is geopolitical leverage. By restricting exports, China forces the rest of the world to either pay higher prices, develop alternative supply chains that take years to build, or accept supply shortages that disrupt production. For industries that depend on silver, this is not a negotiable situation. Demand that cannot fall, supply that cannot rise, an inventory that is finite. At some point, price has to rise enough to either destroy demand or unlock new supply. And based on the lead times involved, we are talking about a multi-year adjustment process. So let me bring this back to the number in the title. $300 by summer 2026. Is that realistic? Let me show you the scenarios. Base case. COMEX avoids outright default but uses rule changes and cash settlements to manage delivery pressure in March. Physical premiums stay elevated. China export controls remain in place. Industrial demand stays strong. In this scenario, silver consolidates between $80 and $120 through spring and tests $150 by mid-year as supply tightness persists. Bullish case. COMEX faces significant delivery stress that raises questions about inventory credibility. More contracts stand for delivery than expected. Shanghai premiums widen further as Chinese buyers lock up domestic supply. And the gold to silver ratio, which currently sits around 50 to 1, starts compressing toward historical extremes of 15 to 20 to 1. In this scenario, silver breaks above $150 in spring and could spike toward $200 to $250 if the squeeze intensifies. Extreme case. COMEX has a delivery failure, or comes close enough that confidence in paper silver collapses. Sovereign buyers start accumulating silver as a strategic reserve alongside gold. Industrial buyers panic and start securing multi-year supply agreements directly with miners. And the recognition that physical supply is genuinely constrained drives a rush into tangible assets. In this scenario, silver could move toward $300 or higher as the market reprices the gap between paper promises and physical reality. Which scenario is most likely? Honestly, the base case is still the highest probability. Exchanges have mechanisms to manage delivery stress. They can raise margins. They can change contract specs. They can force cash settlements. But here is what matters. Even the base case puts silver substantially higher than where it is trading today. And the risk-reward skew is asymmetric. If the base case plays out, you make 50 to 100% from current levels. If the bullish case plays out, you make 150 to 200%. If the extreme case plays out, you make 300% or more. And if I am completely wrong and silver falls back to $50, you lose 30% from current levels. That is not financial advice. That is just the math of the setup. Now let me address the elephant in the room. The recent crash from $120 to $75. Does that invalidate the thesis? No, it validates it. Here's why. The sell-off was driven by a hawkish shift in Federal Reserve expectations after the Trump administration signaled the appointment of Kevin Warsh as the next Fed chair. Markets interpreted this as less aggressive rate cuts, which strengthened the dollar and pushed Treasury yields higher. Higher yields make non-yielding assets like silver less attractive on a relative basis. So leveraged traders sold, momentum traders exited, and the paper price collapsed. But here's what did not happen. COMEX inventories did not refill. Shanghai premiums did not narrow. Industrial buyers did not stop purchasing. And China did not reverse export controls. In fact, during the sell-off, registered COMEX inventory continued declining. More metal left the exchange than came in. Physical demand stayed firm while paper sellers pushed price lower. That divergence tells you the structure is still intact. The sell-off was a liquidity event in the futures market. It was not a fundamental change in supply-demand dynamics. And if you understand the difference between paper volatility and physical scarcity, you recognize that sharp sell-offs create buying opportunities, not exit signals. Because the people who need actual silver do not care whether futures traders are bullish or bearish. They care whether they can secure supply for production. And right now, supply is getting harder to secure at any price. So what does this mean for you? If you are holding physical silver, the thesis has not changed. The deficit is real. The inventory drain is real. The export controls are real. And the timeline to resolve the imbalance is measured in years, not months. Short-term volatility is noise. Long-term trajectory is driven by how much metal exists and how much is needed. If you are trading futures or ETFs, understand that paper markets can remain disconnected from physical fundamentals for extended periods. You can be right about the structure and still get stopped out by volatility. Position sizing and risk management matter more than being right about direction. And if you're trying to decide whether to buy at current levels, understand that nobody can time the exact bottom. But the mathematical setup suggests that $75 is closer to the floor than the ceiling based on production costs, physical premiums, and structural deficits. Miners cannot profitably produce silver at $50. Industrial buyers are paying premiums above $80 in physical markets, and the supply deficit cannot resolve without either much higher prices or a global recession that destroys industrial demand. Neither of those scenarios suggests $75 is a long-term equilibrium. Let me close with this. The silver market is not about predicting the next move. It is about understanding the structure. And the structure right now shows a market that has been consuming more than it produces for 5 consecutive years. That has seen inventories drained by 70% in major exchanges. That has experienced export controls from the dominant supplier. And that has open interest in futures contracts 4 times larger than deliverable physical supply. Those are not opinions. Those are facts. The question is not whether this resolves with higher prices. The question is how high prices need to go before the market rebalances. Bank of America says $135 to $309. Citigroup says $150 in 3 months. Independent analysts tracking COMEX delivery stress are pointing to scenarios where physical scarcity drives price substantially higher if March contracts create a squeeze. I'm not telling you what to do with your money. I'm showing you the data and the analysis. You decide what makes sense for your situation. But if you found this breakdown valuable, make sure you subscribe and hit the bell icon so you get the next update when delivery pressure starts building in late February. And if you think this analysis helped you see the market more clearly, hit the like button because it tells me you want more of this kind of deep dive instead of surface level hype. One last thing. What do you think happens in March? Does COMEX handle the delivery pressure without issue? Do we see rule changes or cash settlements that signal stress? Or does something break that forces a repricing of the entire paper silver market? Drop your thoughts in the comments because I want to know how you are reading this setup. And if you have questions about any part of this analysis, ask them below, and I will address them in the next video. If you are not subscribed, yet hit that subscribe button and bell icon now. Because the next few months are going to be volatile, and you do not want to miss the updates that help you navigate what is coming. And hit the like button if this video gave you a clearer picture of what is actually happening in silver beyond the headlines. Thanks for watching, and I will see you in the next one.